Eisenhout here again, and today I'm planning to discuss with you the pros and cons of proprietorship versus becoming a corporate entity as you embark on your entrepreneurship career. First off, let's start with proprietorship advantages. This is in effect the cheapest way to start a business. Usually you can get into it for just $100 to a couple $100 to, in effect, register it and get it eligible to conduct business in a local area. So that's one of the biggest advantages for proprietorship, is that the cost of entry is very small. The accounting for it also is much simpler, and one of the really cool things about it is that if in, like, say, the first year or two you have, in effect, losses in your proprietorship, a net loss at the end of the year, you can actually deduct this loss against employment income in your personal income tax returns. The other advantage is all revenues and profits go directly to you. You don't have to worry about dividing things up to the shareholders and whether to do it as dividends or stock or anything like that. You don't have to worry about the salaries or things like that as well. Proprietorships have the lowest amount of regulatory burden and reporting. Corporations, much more sophisticated, a lot more paperwork, a lot more things you have to tell them about your business. Also, corporations have to file a number of different types of returns that the proprietorship doesn't, such as a corporate annual return. Inexpensive, but it's more work. You also have to get GST and payroll accounts, where in some situations as a proprietorship you may not have to, but that's something you need to check into based on the type of business you're running, where and how you're running it. For example, I did a business that was based in Canada, but all my clients were US. And I ultimately got a CRA exemption to run that business, so I did not have to have a GST account and charge GST on things. So it's basically situational specific with respect to whether or not you need a GST account or not. You can also save some money on the employer shares of CPP and EI. If you're working as a corporation, a lot of people choose to take salaries or have salaried employees, and there you have the employer share of CPP and EI that you have to pay in addition to what the employee is paying. Disadvantages to proprietorship: well, you've got unlimited liability. A corporation actually shields you from that to the extent of the assets of a corporation in most instances. If you are a proprietorship, every debt you incur, you are personally responsible for. Also, because of this, as a proprietorship, you have a little bit more time or a little more difficulty arranging third-party financing and investment capital if you need something in order to achieve your goals. Corporations, on the other hand, they can privately issue stock, they can go to the banks and more readily obtain capital there, or from angel investor organizations, etc. So it's much easier for them to get money than it is for a proprietorship. Also, corporations can elect to go public at some time in the future. Proprietorship needs to become a corporation before it is able to do this. Income is taxed at your personal rate as a proprietorship, which is most often higher than corporate rates as revenues and incomes increase. So there are tax advantages to being a corporation. Also, a corporate business name once established is protected. You have no such strength of security with the name of a proprietorship. So a corporation, they do the additional name searches for your state, province, or country, depending on where you choose to operate, and you have that protection of your name. Advantages to being a corporation: well, there is limited liability of directors and officers of the corporation in most instances. It is an entirely separate legal entity from you, and as I mentioned before, the business name is also protected. Easier to raise capital, and there's more mechanisms available to do it, including classes of shares: common, preferred, voting, non-voting, etc. There's many ways that you can obtain capital for your corp. The ownership is transferable and more easily saleable, and it will continue beyond the death of the person creating the entity. Proprietorship, in most instances, will not, unless the will stipulates that it will move to another family member or something. So keep that in mind, that the corporation will survive the death or unexpected death of the individual that started the corporation. Taxes are often less than what a proprietorship is and will have to pay, and you can issue dividends to stakeholders. Now, I'm going to have a presentation coming to you on dividend tax credits in this series. I have found it to be an extremely good way to take your money out of your corporation and pay very, very low personal taxes on it in your personal returns. So be looking for that presentation coming up soon. Corporate disadvantages. Cost of startup is higher than for proprietorship. Remember, I'd mentioned about $100 to $200 for a proprietorship. Corporations probably going to run you in the, at a minimum, $1,500 to $2,000 range. And you can do it either through a lawyer or through an online incorporating website. But you're still going to be looking at, usually at a minimum, about $1,500 to get it started up and get all your minutes, documents, and everything else created. Corporations have much more extensive record keeping required. Balance sheets, income statements, source and use of funds, returns on payroll, on GST, year-end reporting, annual reporting. You're filing a separate return from your personal entity, so now you've got two tax returns to fill in, and the corporate one is much more intensive, a lot more work. People that are not knowledgeable in accounting and tax returns often have to hire that out to a third party in order to get that job done. So there's more cost incurred there as well, so keep that in mind. Business losses can't be written off against shareholder incomes as in the case of a proprietorship. So you can't get that extra tax benefit on your personal return if your corporation suffers a loss. It lives, eats, and breathes on its own accord. And more complex to manage and operate. You now have to define your shareholders, your directors, your officers, your classes of shares issued. So there's just a lot more work involved in the corporate side of things. But as I mentioned before, the tax breaks as you start making money will often make that worth the transition. A few personal thoughts on this. Well, if you're in a business of low financial risk and possible lawsuit from outside parties, there really is less pressure on you to incorporate. So don't be thinking, I got to go protect myself if I'm really not in the kind of business where it looks like I'm going to get sued anytime soon. Because one of the reasons that people do incorporate is so that they can set up a separate legal entity to avoid personal financial exposure if things go wrong. Another reason for the incorporation is in the instance where incomes and profits are becoming significant, then you're going to want the lower tax rates and incentives that a corporate entity will provide you. So that's a good time to think about starting to do your incorporation. Third reason for incorporation is that if there are multiple stakeholders involved, it's probably the best way to go. That way everyone's exposure is limited because there's going to be more than one person making decisions in the corporation and they can affect the well-being of others. If they make a poor decision, you're all liable to cover it, unless you're in a corporate structure where the losses are limited to the extent of the assets and income, etc., of the basically the net worth of the corporation. And again, corporations survive a person's death, so if you've got 3 or 4 stakeholders in the corporation, the others will be able to carry on without any difficulties if one of you is no longer in the picture. Closing comments. Well, individuals usually start out as proprietorships and they evolve to become corporations as their businesses grow. If you have partners in the business, consider becoming a limited liability partnership to minimize your personal financial exposure. I didn't discuss LLPs in this presentation, but information's out there and you can research it on the internet. If you become a one-person or small corporation, consider taking dividends as opposed to salaries from the corporation. Even Canada Revenue Agency recommends that strategy, and I will be doing a video presentation on this later on in the series. If the first year or two of business show loss, or you know that you're putting in some investment capital that is going to put you in a negative position for the first few years, don't incorporate yet. Use those years to offset your employment income with the losses of the new business you're starting. And you're going to get some nice tax breaks from that. So that is definitely worth considering, and it's a strategy that I would employ. In any event, that's the end of this particular presentation. If you've liked this and you want to see some of the other ones coming downstream from here, top left corner you'll see the YouTube logo and a subscribe to our channel button. Click on that, subscribe, and you'll be sure to get everything else that we create in this series. Thank you again for your time, and look forward to talking to you again soon with another presentation. Bye for now.